licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionclearing.com, to read characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you can't afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific date or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, there. Now we're good. All right, so let's see. Can I get on YouTube? No, we cannot get it on YouTube because it's not ours. You know, it's a copyrighted material from BNN, and they're Canadian, so forget it. It's all right. The links work. We have links that work, and I'll put them up later. Anyways, it's me saying the same stuff I say here. It's really, I mean, just it was cool in front of an audience, I guess, but it's really not that different. All right, so let me get rid of this thingy. I'm going to share my screen if I can figure that out. There it is. And we'll all be surprised by what comes up, because I never remember. What? Oh, there we go. All right, you get the thank you for using WebEx screen. Isn't that great? Move my little chat box around. When you see random mouse movements, that's me moving the chat box. And let's take a quick look at the markets. Okay. So I mean, I guess I did a good job warning everybody the market was going to crash, because really nobody has questions on positions or adjustments or hedges or anything. I think that's very interesting. You know, I mean, not just here, but in the chat also, because like, you know, everybody seems to be very well positioned for where we are. So that's good. I'll tell you what happened though. I mean, I was in, you know, I mean, obviously I was worried all month. I've been worried about the way the data is diverging from the market, and it just got to like a really critical point this week or last week. And when I went to Toronto, you know, for starters, like whenever I go to the airport, like I go to the lounge and I hang out and I talk to people, and I didn't hear anything different from the people I was talking to from different parts of the country. So that's problem number one is, you know, you kind of think, I'm like, you know, when you're in one place, you're kind of like, well, maybe Jersey's in a rut. I live in North Jersey. Maybe New York is a little tricky. I just posted today some comment from a guy in New York who's just on his last, having his last straw because they raised the subway fares again. And this is what I see going on locally, though, especially in my community. I see property taxes are completely out of control. The electric bills are out of control. All these, you know, everything that you can get people on, and when I say, you know, when I say anything, the corporations, and the same, and you know, the same guy who sells you soap and sells you a car and sells you something and sells you Kentucky Fried Chicken, he also is selling you your gas and electricity and so on and so forth. It's all, this is the problem with society. It doesn't matter. They're going to get you one way or another. And I don't want to sound like a Joe Socialist here, but I'm telling you, this is a problem with capitalism. You know, so when you have, in other words, there's no competition. See, logically in capitalism, you think that, okay, well, there's going to be an equilibrium, because if toothpaste is too expensive, then the price of something else will go down. And if the price of something else goes up, the price of toothpaste will go down. And they'll have to fight it out in the marketplace for the consumer dollar. But that's not what's happening, because the people who actually own everything, which is 1% of the people own everything. You can talk about other people owning crap as much as you want, but 1% of the people own 50% of the stuff. That's the way it works. So they own everything. The fact that some other people own some other stuff is irrelevant when 1% own 50% of the stuff. And I think they're getting close to 60% of the wealth at this point. So the problem is, though, here's the thing. Instead of there being competition for your dollar, it's just 8 different ways the Kochs are taking money from you. The Koch brothers are trying to take your money, okay? If they can't get you with your toothpaste and they can't get you with the paper towel, then they'll get you with the mortgage on your property because they own the bank. And if they can't get that, then they'll raise your electricity fees and squeeze you there. They're going to get your money. That's what they're in the business of. I mean, realistically, that's what everyone's in the business of, trying to get your money. But there's no healthy competition when everybody when 1% of the people own everything that you're doing. They're not competing with themselves. They're just finding different, more effective ways to take your money. And in fact, they actually look at the cheapest way to take your money. In fact, in other words, it's not effective for them to charge a lot of money to sell you a tube of toothpaste. That takes marketing and so on and so forth. So it's easy for them to sell you a low-cost tube of toothpaste. But it is easy for them to raise your electric bill because you don't have a choice. You can't switch. So people are getting squeezed. That's the bottom line. People in the bottom 80% especially. And frankly, if you're an investor, if you're sitting here listening to this webcast, the chances are you're not even in the bottom. You're not even below the top 10%. You have money to invest. You're in good shape comparatively in this country. So, and I would have to say that when I ran my company, I would say the lowest level of people I would generally come in contact with were still in the top 80%. I mean, still in the top 20%. I mean, you rarely in a top 10% lifestyle, you rarely come in contact with people who are very far below you. And I mean, I'm not talking about the guys washing your window at the car wash and the waiters and the waitresses at the restaurant. You're not really dealing with those people. They don't work for you. They're not doing stuff for you. Anyway, so those people are all hurting, though. They're really getting killed. All the people who work for wages and have student loans and are in debt and so on and so forth. It's not good. And if it's not good for them, then it's not good for large portions of the economy. And you have to be very careful about what you're getting into and what you're selling. So in my travel, as I'm talking to more and more people, I'm getting this picture of how hard it is to make a buck in America, even for the people who are sitting in the first-class lounge room, and people who are traveling and in good restaurants and so on and so forth, and the people I met in Canada were high-net-worth people. Everybody's got trouble because you can't get any more money. You can't squeeze blood from a stone with the consumers. So that on Saturday got me started to be a little bit more worried than I had been. Also, then, we're heading into earnings, and of course I'm obviously very concerned about earnings. And by the time I had I did tape the show on Monday, and then by the time I met with these people, the audience these were high net worth people in the audience. They invited to see the show, and they had a dinner reception afterwards, free of course. If you're rich, everything's free. So they had a dinner reception afterwards, and I'm talking to these guys, and even the picture, I talked to guys from China, I talked to some guys from Japan, I talked to some people from the Midwest, and I got the same picture over and over again. And that's not good. So I woke up Tuesday morning, I had kind of a moment of clarity. I said, let's get the hell out of this thing. This is stupid. Why am I still in this? Because really, and another thing I have is don't forget that every time, because we balance our two portfolios, the short-term portfolio and the long-term portfolio, we try to keep them balanced. The long-term portfolio had shot up to 33 and 1/3% or something like that. And in order to protect it, I would have had to spend more money in the short-term portfolio to protect the long-term portfolio just to hold on to these gains, which I didn't believe were holdable. So it just got ridiculous. So I gave up. I said, let's get out. I feel better in the cash. And boy, do I feel better. So that's what drove that decision. That's what drove the timing. It was sort of, I guess I was feeling it coming into it, and it just was sort of a last straw thing when I went on that trip, which is fortunate, because had I been sitting here doing the same stuff every day for the weekend and not change it in my routine a little bit, I might not have felt that sort of urgency to get the hell out on Tuesday morning. But I did, just because I sort of took that step back and went around. Anyway, so that's why we called out. That's why we got out of the long-term portfolio. We'll take a quick look at it. I have not fixed it yet. I haven't actually, because it's been, Power Options crashed yesterday. and I didn't get a chance to change anything. So it's still stuck with all the old positions as far as it's showing. But you know what? They didn't take all that much damage, actually. We're still at 32.7%. These are the same positions we had, and we've killed most of them. I made a list. Hang on, let's see if we can find the list. I made a list yesterday, was it? Okay, well, let's find it over here. Oh, no, I made a list Tuesday of what to keep. Sorry, no, it wasn't yesterday. So Tuesday morning, I said when we started I put the comment post to get out. And see here, as of yesterday's close, long-term portfolios up 33%. And that's not supposed to ring. Hang on. Sorry about that. And it's going to keep ringing. Anyway. Oh, come on. Professional broadcasting. All right. I said, here's the keys. Like, I cannot, in good conscience, endorse holding these huge gains in equities. You're not supposed to be up 33.3% in a year and a couple of months. It's just, you have to recognize when you're up too much and it's silly. And so I said there would be a list and I'd make exceptions. Why is this not working? Jeez. For some reason it wouldn't mute out. So where was I? Oh, yeah. And here were our exceptions. I do realize that OIH was not listed here. It should have been. It was a new trade, and I forgot to list that. So our exceptions were GTAT, because it's really dead money, so it's either going to pop back or it's not. There's no point in cashing down. USO, because we like oil long. ABX, because we still like gold. Oh, and gold really popped. Hovnavian, because it's low enough where I'd be more happy to double down and get out. RIG also. RIG we think will come back, and it's also so low it's not worth selling. BHI, well, we just called that. BHI was a trade I just called on BNN that night, on Monday night. It's got different circumstances. It's not really subject to the same problems as the rest of the market because it's being bought. CIM, they're paying a dividend. We are going to get out of CIM, though, because they're doing a reverse split. So we're going to take our dividend in a few days, and then we're going to cash it out. And then we'll get back in after the split and buy new shares. CLF also so dead that we don't care anymore. Lumber liquidators, they're storage stocks. They're down for a different reason, and that has nothing to do with the market being down. Lululemon, we were actually bearish on. Oh, and they had numbers today. I forgot about that. Damn it. Hold on. Oh, I can't believe I forgot that. Oh, man, up 7%. Well, they're short. We were short on those guys, but they actually kind of flipped up and down. So they had actually better earnings than we thought they were going to have, and it's a covered trade. We'll go over that one also. Mattel, I think, is low enough in the channel where I still like it, and UCO is another bullish trade on oil. So those plus OIH are the ones that I wanted to keep, and we'll take a look at the portfolio. So that means we're getting rid of BBY, DEC, IBM, KBH, SGen, TWX, UBNT, Wendy's, Whole Foods, Apple. We even got rid of Apple because we said, hey, why would Apple not pull back with the rest of the market? All right, so it's just, it's not a call like we don't like Apple. Oh, CIM pays after the split, Pat says. That's not good. All right, hang on. All right, so Apple, we just got out of it because we think we can reposition it. That's all. It's not that we don't like them. Now, we had AREX we got rid of, Annaly we got rid of, even though I love them. Philip Morris, Verizon, Outdoor, Arrow. Boy, I even closed Arrow. I can't believe it. Okay. I love these guys. All right, we closed Arrow. It's a nice gain on them, though. BHI, is the one we kept. Caterpillar, which I want back already. All right, Caterpillar is one of the first ones I want to buy back. CCJ, very big disappointment, but gone. Here's CIM. CLF we just said. DBA, I want back. I don't know why I sold that one. That was a mistake. FCX, that was a tough one, but I decided that I'm just not seeing that recovery in the global economy to bet on. GoGo, I like them, but they haven't been doing anything, and it's just getting kind of old. iRobot, love iRobot. We're happy to buy it back. Lumber Liquidators is one we kept. Lulu. Oh, now somebody said, why were you bearish on Lulu? We're not bearish per se. It's just that it ran its course, and what we did is we cashed out. I don't know what we did. I know what we did. We had the 2016 something call, maybe the $30 call. We had a 30-50 spread or a 35-50 spread or something like that. We cashed out the 30s and left the short 50s. Okay, and we did that because we thought that they would drift back down a little more. And they did for a tiny amount of time, but unfortunately just got burned. So it's not like I'm short Lulu, and what we're going to do is we're going to fix that by getting more long, not less. Because we like Lulu, I just didn't think they'd have good earnings. So here they were, behaving themselves at 61. We cashed out around here, you know, up, I think around here, like really high up, like over 65. We cashed out on our whatever the hell they were, 30s or whatever they were. We took a big chunk of money off the table. Then they dipped, but we unfortunately have been greedy, and we did not. And here, I thought that they were still going to go down a bit further. I thought they were going to come back and test this red line, but they're back here. I'm not reacting yet, but we'll see what happens. But if they're going to support up here, and the market isn't going to sell off drastically, then all we're going to do is add more long. But I'm not bearish on Lulu. I still like them. As to thoughts on Ralph Lauren, I don't have really thoughts on Ralph Lauren. I don't know enough about them and what they're doing and how they're being affected and what their exchange rates are in various countries and blah, blah, blah. It's really complicated. You can't just play every retailer the same way. You have to know their mix. You have to understand where they sell in different countries, not just where they sell, but where they buy and where they sell. Lulu doesn't have that problem. That's why I like local companies, because Lulu is local. Nike, I don't mind, because I already understand Nike. Nike has all their shoes made in China and Vietnam, and they sell them all over the world. That's easy to deal with. So you can just look at the global currency situation for Nike. Ralph Lauren, it's trickier because they have clothes made in different places. They have different manufacturing bases. They have different sales and distribution arms. It's different, you know, you know, and the market's different too. It's a fashion market. Nike just sells sneakers. Everybody wears sneakers. Everybody's got sneakers. It's much easier to deal with. So there aren't, you know, I don't want to be a retail expert who studies clothing constantly. Okay, I happen to know a lot about it because I was in the business for a little while. But it's just, you know, I know enough to say Ralph Lauren is like, it's an iffy one. It's hard to track, and generally I don't see any particular reason that it would be good or bad. Obviously, they've had some issues because they had a tremendous drop, but I don't exactly know what all those issues were, so it's hard to say. Now, let's see if I missed any comments. Somebody asked about the Nikkei, so we'll get to that next. Okay, Rich? What else was I doing? We were going through the long-term portfolio. Let's make sure we finish that. All right, so SLCA we got rid of. SLW we got rid of. Man, I was harsh. I love SLW, and we just like doubled down on them too. I think I'm in the short-term portfolio. Somewhere we bought more of those. SOCL I got rid of. Wow, that was interesting move. I like them too. Taser I got rid of. Love Taser. Boy, Toyota, God, I was in a mood. WFM, holy cow. I feel like I was like firing people and I just got too carried away. So look, these are all stocks we're going to want to buy, but you know what we're going to do now is, now we've got cash and lots of cash, oodles of cash, And we're going to see how the market shakes out during earnings, which is another couple of weeks. We're going to watch and see how the market shakes out. We'll make some short-term trades and make some money, but for now we're just going to kind of watch and see what happens. But the thing is now, into earnings, we have this list. Here's already like a whole bunch of stocks we like that we'd love to buy back, but I'd love to buy them back if they're cheaper. And because we're sitting in cash and we're patient and we're already way, way ahead of our goals, what we're going to do is we're going to wait, and every month we're going to say, well, which one of these stocks got cheaper? Which one of these stocks is now a better deal now than it was when we sold it? And that's when we'll add them back. And we'll add them back for 5% less, and 10% less, and 20% less. And obviously that's good, because if it does, see, you know, you say now, oh, gee, I wish we didn't sell it. Yeah, but you know what? The ones we buy back, if they go back and hit our goals, we're going to be 5, 10, 20% better off. That's why there's no harm in selling stocks, because I don't need to buy all of them back. In fact, damn it, there were too many. There were too many. There's a lot of stocks here. There's like 30-something stocks here. Okay, I don't like to have much more than 20 in a portfolio. So there were a lot of stocks here, and we cut it down. And what did we cut it down to, by the way? We cut it down to a whole bunch of guys, going back to this list, wherever it was. We cut it back to a bunch of guys, especially USO. Well, it already popped now, so we might even lighten up on these. Especially USO and UCO, and ABX, and then RIG and BHI. These are all sort of in the same general thing, and even CLF is in the same thing. They're all material stocks that are saying, hey, if this rally's real, and if the market is popping, and if it keeps going up, then these guys are going to go along for the ride at some point. So they have the most to gain going forward. And if the market crashes, these guys are already so beaten up, they're probably going to lose less than our other stocks. Meanwhile, we get to buy back our other stocks, and we can add to these because now we have tons of cash. So that's the logic to cashing out. It doesn't hurt you. I think a lot of people have this real fear of cashing out. One thing that we've been discussing, though, is the tax implications of cashing out. And for one thing, one easy way to solve that is find a few losers to cash out, and that wipes out your gains, right? So that's one thing. Second of all, though, if you're in a kind of tax bracket where cashing out stocks on timing matters to you for tax reasons as to whether or not you make or lose this money, then you should have your accountant set it up so you're trading in a trust or corporation. They can set up a family fund for you. Nothing, doesn't cost any money. It's a simple little thing with a little bit of extra accounting each year, and then you can trade as a profession in the trust, so that all of your trades wash. In other words, it doesn't matter. There's no more wash implications. It's just trading as a business. So you trade for the profit and loss for the year. Every year you trade based on the profit and loss of that year. You still get long-term capital gains. You're still in that. You still get to do those when they come up. But as for your everyday trading activity, it really actually simplifies it, because it's really just meant that you make or lose money, because that's what your company's purpose is. It's a trading vehicle. And so the trading vehicle that you invested in either made or lost money. All right, so that's one way to fix that. Also, there's a thing called, as an individual, if you're a full-time trader, you can elect trader status. It's an IRS thing that, again, you have to talk to your accountant about it. You can elect trader status, and then, again, it treats your trades as a net. So you take all your trades, and it nets them out, and you either make money or lose money and get taxed on that. And then you don't have to worry about all this rubbish about tax implications. And I know that a lot of accountants don't have a clue about that stuff. You have to find an accountant that knows something about options and understands that. Because especially options, stocks, whatever, you just need somebody who understands the tax implications of trading activity. And any big city, there's plenty of them. There's tons. I mean, in Toronto, you ask your broker, they'll tell you. They'll find somebody for you. They'll know somebody. All right, so let's cover that now. The NKD and the yen relationship that you sometimes mention in posts. Well, that's easy. It's where's Nikkei? Somewhere we have the Nikkei. Trade. Oh, here's the Nikkei. All right. So here's the Nikkei, and where's the yen? That's what is the symbol for that thing here? Or USDJ fuel. Right. There you go. Now, in the yen, unlike most of the currencies you look at, up is weaker. Okay, this is a weaker yen because it's more yen per dollar. So up is a weaker yen, down is a stronger yen. You want to see a relationship? This is nothing really to discuss, Rich, right? Because here's the relationship. It's almost exact. Almost exactly the same, and these time frames are not the same. So let's see if we can. Why is that? Oh, one's 15 minutes and one's 5 minutes. Okay, let's go 30 minutes and 30 minutes. No, they're not lining up. Oh well. Anyway, so over any short time frame, you're going to see a fairly direct relationship. Okay, when the yen goes up, stronger is down. When the yen goes up, the Nikkei goes down. When the yen goes down, the Nikkei goes up. This is very simple. It's a very direct relationship. It doesn't last. As in all currencies, it doesn't last because after a day or so, it gets baked into everyone's expectations, and then it only matters what the net is for that day. That's why you see this. The longer you're out in time, the less even the relationship goes. Other factors kick in. And the same goes to the dollar affecting things also. Stronger stronger pushes down the equities and pushes down the commodity prices. All right, so that's generally how it works, but it doesn't last. But during a day when you're trading, oh, absolutely. It's almost a completely direct relationship during the day, and then the effect fades out over time. That's how you look at it. So I hope that helped. Oh, you know, you said that about CIM. I just want to double check that and see. That seems odd. It's not what I saw. CIM, as far as I know, they're paying dividend any day now. And why is it so slow? Oh, come on. Seriously? That's odd. Did they split already? What is that? Screw this. Well, I'm baffled. Yahoo's having a big problem. All right. Anyway, unanswered question, but if CIM is paying after the split, I guess I would rather hold it. I don't know. We'll have to discuss it after we get all the facts straight. Let's see. Sudden weakness in the market last 5 minutes. Giles said, oh, something happened. Nope, nothing happened. It gave up. All right. Yeah, well, it's not weakness in the market. Well, is it weakness in the markets? Let's see. Well, earlier here we were looking for bounces, and I'll show you what they are. Because using the 5% rule, this is not complicated. All right, it's a very, very simple, very basic part of the 5% rule is that you expect to get a retrace. It's also like I keep saying, it's a Fibonacci retrace too. All right, so somewhere here, I do these charts. Oh, here we go. Okay, great. So here's from our chat room this morning, and we did these charts, and unfortunately they don't update. These don't update. But in any case, so looking at the S&P, we'll stick with that one. So what did it do? It went from 502. What? Okay, it went from 2100. Okay, here's 2100, and it fell to 2050. That's 50 points, right? And then 50 points is right about 2.5%, or it's probably. Let's see. 2150 divided by 2100. Yes, 2.5%. Okay, close enough. You know, I know this blows a lot of people's minds who love to have everything be exact or something like that, but it's not an exact science, because all we're doing is eyeballing the 21. Because you say, look, it was 2105, or you know, it's 2049. So when you see 2.38%, that's a 2.5% move. All right, and a 2.5% move is very significant on the 5% rule when you're dealing with a major index. Okay, a 1.25% move is also significant. You know, the more liquid something is when you're trading it, the more the sub fives come into play. So half of 5, 2.5, half of 2.5 is 1.25, and even 0.625, which is half of 1.25, starts coming into play. So where were we? Oh yeah. So here's your 2.5% move. We expect a 2.5% drop, right? That's perfectly normal pullback. So if we expect a 2.5% drop, and we expect there to be support at the 2.5% line, and 2050 is also, and also has the benefit of being a nice round number, and we expect support at the round numbers, and I mean 2100, 2050, 2000, those are the round numbers. So we expect support there. Also, 2035, see 2033, see it, 2035? 2035 on ES. Look how well that worked out too. Here's 2035. Wait, let's get it exactly. Come on, mouse. All right, close enough. Anyway, see where that is right there? 2035.19. See the bounce? Exactly where we predicted it on the big chart. And that's the same big chart, and here it is again, 2035, 2035. That is the same level that we predicted to be the not the must-hold line, the 10% line on the S&P since, I think, a year and a half or 2 years ago. We've been using those same levels. So that's how well these predictions work out. All right? Futures are better for watching the big chart than the actual indexes, because this is a blend of what people expect between now and June. These are the June S&P contracts. So when you look at these futures, you're looking at a blend of expectations for the next 3 months. These are going to be a much better gauge of where we are than the front month contract that's trading or the front month index that's trading now. All right, so always keep that in mind too. But since 2050, so in the regular index, the psychological numbers matter more than the 5% line. All right, but we happen to hit both. We hit this psychological barrier and 2035. That made it a very powerful bounce. And early this morning, I called this long for bounce off of this line, not off that line, off 2035 in the futures. And how much of a bounce do we expect, though? On a 50-point drop, you're going to get a 20% retrace of the drop. That's going to be 10 points, is a weak bounce. And a strong bounce is going to be another 10 points. It's going to be 20 points to 2070. So 60 is a weak. And in fact, I didn't make that dotted line. I don't know why I say it, but that just happens to be the weak bounce line. So that would be a weak bounce, and 70 would be a strong bounce. So we're not going to be impressed at all until we see 70. But also, though, you need to see a weak bounce in the first day after it hits the bottom. Otherwise, you give less credence to it. So we want to see a weak bounce today and a strong bounce tomorrow, and then you could say we're on a recovery path. Now, if you're over the weak bounce, or if you hit the strong bounce in one day, that's a good recovery. That's when you get those V-shaped recoveries. All right, but I said this morning, I think that's going to fail. So we'll see how we're doing now. It doesn't matter. You know, and again, from 2035, it's still the same 10 points that we're going to be expecting for a retrace. This guy went from 2090. Well, that's not really enough days. We can go to a longer chart. 30 minutes. Okay. Here you go. So here we're like from 2100, say 2100, you know, we'll ignore this spike up, but from 2100 down to, call it 2040 is 60 points. So here we'd be looking for a 12-point move. Oh, look at that. That's interesting. So we got exactly a 12-point bounce. And in fact, we stuttered at the same 12-point line on the way down, so you kind of knew it was going to become a thing on the way. Since you found some support there on the, coming down, you know that's going to be the weak bounce. Before it even finishes falling, you count, well, what's 2.5% down from here? It's going to come out to there, and you know 2035 is support, so you expect a weak bounce, and the weak bounce is to here, 2052, where we are exactly at the moment. And on the way down, the fact that we consolidated a bit at 2052 was a very strong indicator that we were going to get a bounce. Okay, and you can say, oh yeah, that's all easy to say in retrospect, but the fact is we called that this morning, we called it, right? We called that here. This morning I said, hey, let's play long here. So it's not retrospect, we can call this while it's happening. This is a very, very useful way to look at the markets. The 5% rule is a fabulous, fabulous thing to look at. So basically, and again, sorry to flip back and forth because the futures and the index are not the same. So you have to kind of, it's got a different number, but I care about the futures because that's what I bet on. So we're out of these futures, of course, here. This is plenty of money to make them in a shot. That's a good run for the S&P. The next thing would have to happen from here, from 2052, we'd have to get to 2064 or 65, and that's right here. And you can check the validity of that here. You see how that worked out over here? It already did consolidate over there, so you know that's going to be a good point to hit. All right, so if we hold this now, then tomorrow we should get up to about here at least. And then if that's successful, we can really expect to get almost all the way back up. We might get another test up here. That would be less of a sell-off than I expected, though. What I'm expecting is to fail here at the weak bounce. I don't think the selling's done. I didn't see a big volume blow-off at the bottom. And I think that we're going to continue down and make at least a 5% correction. That's what I think is going to happen. But just because I think it's going to happen doesn't mean I'm going to play it that way. So we're going to just wait and see and watch what happens. But so far, I have no reason to capitulate on our short positions yet. All right, so cashed in long calls, Jim. Would you get rid of the eBay? Would I get rid of an eBay 45 put? That sounds like way out of the money, right? So probably not, but only, it goes back to, see, here's the thing. It's not, these things aren't in a vacuum. It's like, how much do you really, really want to own eBay? That matters. So where are we? Here you go. So Jal said that. All right. So eBay hasn't been below 45 all year. All right. So it looks pretty, or it was a couple of years actually, hasn't been below 45. So here's the thing. If I want to own eBay for, well, net 40, if I really want to own eBay for net 40, why would I care if it goes down? I want to buy it, right? So my answer would be no. I don't want to sell it because I want to buy it. That's why I asked if I could. I said to this guy, could I please buy eBay for 40 bucks? And he said, sure. I'll pay you in fact, I'll pay you $4.25, well, for 45. So I'm basically getting it to net 40. I promised, I said to this guy, I'll buy your eBay for 45, and he said, I'll pay you $4.25 to make that promise. Thank you. Okay. So we're both happy. I think I'm a lot happier than he is. So the bottom line is, if you made a bet, then no, get out of it, because it's probably like $1, right? I mean, let's see, what did he say, the eBay? There's a big difference between betting and investing. And if you're betting, you have to know you're betting. So he said the 45, look at that, they're like $1. Yeah, I thought, okay, great. So in other words, now the question is, did you really want to buy eBay for 45? Because you certainly risk buying eBay for 45, and you're only getting paid $1 to take that risk. Earlier, you were being paid $4 to take that risk, and you thought that was a no-brainer, I guess, so you did it. Now you're only being paid $1 to take the same risk. Now, you say, well, could you substitute it? Well, you could substitute it. You can go to another one. Like, you can take these 45s, and they're like $2.50. So now you can get paid another $1.50 to take the same risk that you're taking right now, except you have to wait another year. But the time shouldn't matter. It's like if I ever get a chance to buy eBay for that price, I want to buy it, right? So that's up to you. You have to look at margin consideration, whether it's worth it, whether you have, if it's just margin sitting out there and you actually want to own eBay, then there's no reason to close it, right? If you don't need the margin. But if you're short on margin and it's forcing you to hold off doing other things, or if you actually don't think you want to own eBay, if the market crashes 20% and eBay's back at 45, then get rid of it. You made tons of money. You made 75% of your money already. And by the way, if you want to have a rule of thumb for naked puts and naked calls, that is the rule of thumb. I mean, if you make 50% before, well, if you make 50% in less than 3/4 of the time, you should be looking to take it off the table. That means a fairly tight stop. If you make 75% between 3/4 and the last 10% of the time, you should be looking to take it off the table. I mean, from when you bought it, of course. And if you make 85% up until the last minute, you should have tight stops and be looking to take it off the table. Unless you are so sure it's going to expire worthless that you could care less. But the fact that you're asking the question makes me think you care, right? Makes me think you're not so sure you want eBay. See, if you said to me, would I get rid of the Apple 85 puts? I said, no. Will somebody please sell me Apple for $85? Please, please, please. Why would I get rid of that put? There are no circumstances under which I do not want to own Apple for $85. So I don't have a question. I'm not going to be asking, what do I think about that? Right? I'm not going to be worried about that. I know I want Apple for $85. If you don't know you want eBay for $45, then take your money. All right? You will get other chances to sell other things and make money on it. All right, so Jim says, yes, and Jim points out, nice thing about cashing out is less need to hedge. Yeah, it's so relieving. It really is. You don't have to worry about anything almost. It's like a whole burden off. Chrissy says 6J. I have no idea what that means. Steve, that's what I thought. Dividend tomorrow and split on 4-6 on CI. And that sounds like what I remembered it was going to be. So we're going to take that dividend money, we're going to put it in the bank, we're going to sell off our position, as long as we get a good price, not panic selling, but as long as we get a decent price, and then when it reverse splits, we'll take a look at new options to buy. An extra dividend on April 30 if you have fractional shares. Yeah, that's the thing I don't even want to be involved in. I think I'd rather just wait until it's clean. Please do the same for Russell. It's going to be the same thing. Come on, I really got to do that again. I don't want to. All right, Russell. Now, the Russell usually is a little bit closer to its actual futures contracts, more so than the other ones. Let's see if we still have that though. So the Russell bottomed out at 1220, where we went long, brilliant play, all of that, and it's the same thing. We just wake up in the morning and look at these things and go, hey, whatever. All right, so the Russell is actually about 5 to 7 points low. Oh, by the way, that's important to know. The index is more bullish than the futures. You have to realize that. So when it's one thing you should always look at. And generally, the index is a little more bullish than the futures, but you look at the trend of that. Is it widening, or are people actually looking more pessimistic down the road than it is today? Well, then why would you be going long if the futures are trending down, but the indexes aren't reflecting it yet? So as is, the Russell's about 5 points below the index here. But it doesn't matter, because once you establish the amount of the bounce, and here we said we went from 1265 to 1225, which is 40 points, and that means we're looking for 8-point bounces, but I rounded them up to 10 because the Russell is so volatile. And again, I know I've made the 10 as a big deal, like from 8 points to 10 points, but the Russell will go generally more to the 5 lines than anything in between. That's for one thing. For another thing, it's not that exact of a science. So, and we know the Russell is extremely jumpy, so I'm not going to be very impressed with an 8-point move in the Russell. It can do that in 5 seconds, as it already did. So I decided that we look for 1235 and 1245. But because the futures are lower, we're still looking for the 10s. But, so to get those numbers, what you're looking for is a 10-point bounce, right? Same logic. And here you can see it, 1260 to 1220 is the same 40 points. And using that same logic, we're going to look for the same 10-point bounce. And here it is, right? 1230 is a weak bounce. And see how it exactly died at 1230 earlier? Exactly. That just shows you how right that line is. All right? And in fact, here's the 8 line, which is the proper line. It's the 8 line, and it's right here. And you see how that works out too. So essentially what this tells you is the Russell is being traded by a computer. That's what the 5% rule measures. It tells you what a computer is going to do. That's how I designed it. You know, my dad and I used to consult on these systems when the original trade bots, when they were designing it, my dad and I used to consult on these things. And I started observing that this is how they all work. It's like you can't predict how any one is going to work, but when you look at all of them as a group, they do follow some very strict mathematical rules. And that's what the 5% rule is about. So it's a combination of that plus human behavior that I observe and the way that people set up programs and design things, and then the behavior of the programmers themselves who interpret the instructions that are given to them, and then the interpretation of the people who are actually using the computer after the programmer designs the program, who they then start fudging with it. It's an amazing thing to watch these things grow. It's like fantastic. So anyway, so when you see that kind of stuff happening, when it does exactly what you predict it's going to do, that is a very, very good sign that there are no human beings trading pretty much at all. The human trading is insignificant here. So we have, at the moment, a weak bounce with a 20% overshoot of the bounce, which is something we often expect to see. It seems to be a spike, and if it comes back down, great. If it stays here, though, if it stays above 1230, that's a successful weak bounce, and then tomorrow, you might get followed through another 10 points to the upside. And then we'll have a real test over here at 1240. And it's interesting because obviously we predict 1240 is going to be a strong bounce. It fell below the strong bounce, failed to get back over the strong bounce, and then went to the weak bounce line, failed the weak bounce line, and now it's at the goal of 1220. That's it. It's all very, very simple and predictable. And what happens on the way down, you can expect to see something similar mirrored on the way back up. And, you know, you see these patterns all the time. This is why, though. It's because it's being traded by computers. So, eBay. Oh, that's an interesting concept. That's why I don't have eBay. You're right. It's because the PayPal thing messes it up. All right, so sim, owner of record on 330. So wait, we have it on 330. Then we get the split for it, but what if we sell it? I don't get it. I don't know. All right. I don't like that. That messes me up. All right, screw it though. We are gonna get it out of the portfolio because exactly that. Though I hate those hassles. We're just gonna sell it, cash, and whatever. You know, it can't be bad for us to get back to cash. Will eBay be the same after splitting PayPal? No, it won't. PayPal's a good source of revenue. PayPal's a good source of future potential for eBay. I don't know why they're doing it. I mean, I guess on the whole, somebody's going to get rich spinning on PayPal, but I also think that Apple is kind of killing, between Apple and Square, I think PayPal's future prospects are dwindling, and so they're kind of taking the money when they can, because I don't think that they're not looking ahead to a really bright future with that thing. I haven't heard any really super bright ideas for what they're going to do with PayPal, and there's so much competition now. So as far as that goes, I mean, yeah. Now, you know what? Now you mentioned the PayPal thing, which I forgot about. I think it probably would just get rid of the eBay and move on. All right, so what do we think about oil, 51.20? Well, we shorted oil this morning, and I hope everyone's done with that now. It's obviously bounced. CL. That didn't work, did it? There we go. So this morning we called a short at 52, which was brilliant, and down it went. And then all the way down to 50, and when it hit 50, I said, I hope you guys are done, bounced out of that short, and that's that. And we didn't go long, because we don't know what the hell is going to happen at 50. At 52, we had this conversation yesterday, because at 49, people were asking if I'm comfortable shorting. I said, well, at 50, I might like to short, but very tight stop. That didn't work out. But then when we hit 52 in the morning, I said, oh, that's a short. You know, and that's just too good to pass up. You know, having hit 52.50, and failed, and then we were seeing 52 again. I was like, oh, that's beautiful. That's exactly what you want to see if you want to get in short. So we did take that short. We wrote that down. Now, back to 51. I think I still would want to wait for 52 and try to get short again if I was going to do it. All right, so what else is going on? All right, good. We covered that. I'm happy. Don't have time for a long seminar today. I have to do something very shortly. So if you have questions, please ask them. We do not have that much longer. Do we have any thoughts on SanDisk? I don't know. I didn't see the actual numbers for SanDisk because we've been doing so much stuff today. Let's take a look. Why not? Since nobody else has a question, I will take a look at SanDisk's numbers. Okay. Oh, geez, really? That is painful. All right, now but without even reading, let's take a look at what this looks like here. That's kind of crazy. Lordy, lordy. Okay. Well, this was silly for starters. Okay. This, all right. I'm not even getting into what they really were, but let's just say, assume 50 was fair. There were plenty of people who thought they were fair at 50 in 2013. Okay. A year later, they double. You know that's silly, right? There's no way their business doubled in a year. There's no way their profits doubled in a year. So now let's take a look at that and confirm it. I don't really have to, though. I'm sure they bought back a bunch of their own stock. But there we go, okay. In 2013, they were earning $1 billion. They knew that. These guys knew that. Where are we? Look. These guys knew this story. Okay, they didn't suddenly earn $1 billion in the fourth quarter. It didn't spike up all of a sudden. They had grown nicely. They had a poor year in 2012. They had a much better year in 2013. They were accordingly went from 40 to 50 and up to around 60, which is very fair, okay? But then what happened the next year? The next year things started getting silly because nothing changed. Revenues the same, earnings the same, yet the stock, for whatever ridiculous excuse of a reason, went up another, basically from 60 to 100, another 60%. All right? So when you see a correction like this, you can't fixate on the stupid number that never should have happened. You got to say, well, this was all wrong anyway. Everything above 75 was probably wrong. So all they're doing now is correcting back. And you can even see it here. People started getting worried. They already were showing signs. They can't sustain those numbers. They can't show that kind of growth and get into and grow into what they're being priced at. All right, those are the quarterly data. See, this is flat. This is nothing's going on here. They're not doing anything special. So all they're doing really is repricing where they should be. Now, they earn $1 billion. They earn $1 billion, and the company has a value of, oh my God, what is wrong with these people today? The company has a market cap of $14 billion, so they're trading at a PE of 14. Now, I am now interested, okay? 14 is not bad. Even for a not growing company, I don't mind paying a PE of 14. All right, so let's see what they are saying now about their earnings. Stock a day, SanDisk sinking, SanDisk lowest Q1 revenue outlook. Here we go. How bad do they think it's going to be? I got to think it's this machine because it seems like a lot of stuff is slow. They lower their guidance. Flash memory chip maker revised its Q1 outlook to $1.3 billion, down 13%. Here you go. There's the key. down 13% from last year, and below its guidance of $1.4 billion. Now, that means their guidance, the thing that dropped them in, where are we? The thing that already dropped them in January, like you said, you're right, Ken, because what already dropped them in January is dropping them again now, except they didn't give you the full scoop in January, did they? They're lowering their guidance further, and they're dropping it to here. Now you get into more esoteric issues. Now you have to start thinking, well, how's that going to really affect their earnings, number one? Why are they saying that? So product delays, lower than expected sales of enterprise products, lower pricing. So they're having pricing pressure. That's not going away. They're having product delays. That does go away. They're having lower sales in enterprise. We know that because businesses aren't spending any money. That probably isn't going away either. So what else about them? 15 months. Blah, 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 blah. All right, so now we got to look at the company in different ways. So now we got to say, okay, what kind of company is SanDisk? Okay, I'm not a huge fan because I just think it's a commodity, basically. But like I said, 15 is good if I didn't think they were in decline, but they are in decline. So I think 15 is probably fair. So this is probably a fair price for them right now. What else I want to see is what do they got on their balance sheet? They're probably very clean because they make a lot, they have good cash flow and such. So they got $1 billion here, $1.4 billion there, some receivables. They got these investments. They don't really have any bad payables or any other nasty things looking around. They got payables and receivables match up, so those cancel. So a couple of billion in cash, $3.5 billion in investments. That's different than equipment. That's the actual invested money somewhere. Not much debt. These guys are fine. So they're in good shape. And let's take a look at their cash flow. That'll show us where they buy back their stock. Oh, I hate that. Look at it. They bought $2 billion. Now, let's keep in mind it's a $14 billion company that in the last 2 years has bought back $2 billion worth of their stock. So that's the only reason their PE ratio looks good is because they spent $2 billion buying back 14, and what's 2 into 14? It's like 1.5, 15%, right? 2 divided by 14? Yeah, 15%. So they bought back 15% of their stock in the last 2 years. All right, see that? That's sale of stock, negative $1 billion, negative $1.1 billion. That's $2.25 billion worth of stock. That's close to 20% of their stock they have bought back in the last 2 years. Even more concerning, if you think about it, if you're a SanDisk shareholder, and this is my complaint about most of the market, all right? If you're a SanDisk shareholder, here's the breakdown. In the last 2 quarters of last year, they bought back most of the stock, $800 million worth of stock. In the last quarter, when the stock was, where are we? Here you go. When the stock was at its most, at $100 a share, these morons are buying it back. They bought $800 billion. They bought 5% of the company at $100 a share. They just lost. Let's see. Okay, so now let's do the math. So they spent $800 million. So that's 8 million shares. So they have 8 million shares, and they just lost $35. So times 35 is $280 million down the drain buying back their own stock. Hate that. I really hate it when people buy their own stock. It just drives me nuts. And especially, I don't mind if people buy their stock when it's cheap. But when people buy their stock when it's expensive, that pisses me off. And all it does is distort the earnings. By cutting their shares 20%, they make it look like, oh yeah, there's a chart for that too. Hang on a second. Analyst estimate. I don't know if it's going to be readily apparent, but yeah. Okay. So the actual amount of earnings is declining. Year ago EPS 560. The current year EPS 526. They've cut down their shares by 10%, but the earnings are still dropping by 10%. That means there's 20% decline in actual earnings. All right, that's not, it's not healthy, and it's not a company that I would jump on to invest in because they're wasting their money. And you know why they do it though? Why would a company, what on earth would make a company spend they lost $280 billion, and please, don't tell me they didn't know their stock wasn't going to go down. Don't tell me they didn't know $100 a share was ridiculous. Of course they know that, okay? They know their earnings are declining. They know they're playing games to keep their EPS up. They know that it's eventually going to come out, but you know what it does? It makes them look good for another quarter or two, so the guy can, the CEO can go take his yacht trip and go do whatever and not feel bad about it. All right, and they all vest their options and do whatever. It's a whole scam. So no, I don't like it. I don't like companies that do it, and I don't even think I don't think they're cheap. I think they're just basically probably fairly priced, and if they can't get their act together, they're overpriced. All right, because they look, for 2 years, these guys have been buying their stock. They did okay here in 13, but here, this whole year, they blew it. Every penny they spent on stock in this year is a loss. All right, and if you go down to 50, then you'll say, oh, this is a loss too. So how much, if you're a shareholder of this company, is that what you want them to do with the money, is buy their own stock to pump up the prices, decrease the shares so they can fool you into thinking they're earning more than they do? No. All right, that's not a good company. Now, Buffett buys back his own stock, but Buffett buys back his own stock at a price when he says, I'm drawing a floor on my stock. So Berkshire, B-R-K, I forget how these guys go. Stop that. Oh, they do points. Everyone does them differently. B-R-K, point A. So Berkshire, right about here, and that was them. He's probably raised it to here. But Berkshire, this was their old line for buying stock. So this is Buffett buying, but he buys at the bottom of the range that he decides based on the valuation. Then it kicks up, and he'll buy again at the bottom of a range. He'll keep it at a certain price. Then it kicks up, and he's probably buying around 210 now. He's probably buying at the 50-day moving average. And it's not the 50-day, though. He goes by the value. He says, how much money are we making? And I'm willing to pay a PE of like 13 for my stock. So if it goes below 15, I'll start buying my stock. I don't mind that. In fact, when Apple, I wrote an article because when Apple was being priced at some stupid amount of money, I was like, well, they've got like I forget the number. They had a couple of $100 billion. I said the best thing they can do with their money is buy their own stock. In Apple's case, I was like, why wouldn't you buy your own stock when it's that cheap? It was like, I forget what it was. It was like, in the old money, it was like $400 a share, so $350 a share. It had taken a dip. And, I mean, what would now be $350 a share? Oh no, I'm sorry. In the old money, it was $350 a share. So divide by $7, $50 a share. There you go. Sorry. It's what would now be $50 a share. And when it was $50 a share, I wrote an article saying Apple should take all their money, all their overseas money, and buy back their own stock at this price. Because it's worth it. There's nothing better you can do with your money than buy Apple stock at $50 a share, not back then. I said, you can't buy another company. You can't build anything. You can't do anything. You're going to make 100% buying your own stock. So sometimes it makes sense. It doesn't make sense when your stock is up. And that really drives me nuts, what SanDisk is doing. All right, so no to SanDisk. All right. Alice Adair says, oh no, what'd I do? Uh-oh. Ha, got it back. All right. Can you please show how you enter a bull call spread on thinkorswim with both legs using limit orders on both? TOS seems to want to default to the S. Oh, sure. Okay, that's a good question. Bull call spread. What's a bull call spread? Let's say lumber liquidators. Lumber liquidators back at 30. And let's say you want to pick up a January bull call spread. So step number one, identify something you want to do. And I don't look first for the leg I want to buy. I look for the leg I want to sell. So when do we start losing premium fast? And it kind of drives that. Here's a good spot. So around the 37s, are 470. These guys are, they're not 610. That's hard. That's tricky. These guys are 6. The 33s is 6. The 28s are 8. All right, now this is getting interesting. Okay, here we go. All right. So the 28s are 8. The 25s are only 930. That's a good deal. I don't think these are really 10. That doesn't make sense based on the bid and ask. I think the 28. So I think that's good for you. So let's say we can get these to 8. So what you do is you, I'm sorry. So I want to take the 28s. Not yet. I'm going to take the 28s. That's not the 28s. Those are the 28s. So I want to take the 28s, 8, probably more than 8. I would always want to look in the middle. So figure that's an 80-cent spread. So 810. All right. So 810. I would want to take the 28s, and then I want to sell something for what? Like 410 would be a nice number. So who can I sell for 410? Well, I can certainly sell these guys right here, the 40s. Now, that makes a $4 spread, and it's a $12. It's a $12 spread, and I can get it for $4. But that might be a little greedy. Do I really think Lumber Liquidators is going to go to $4? I mean to $40. So let's go here. We'll put in LL. And we're going to look at the chart. We're going to see that there are plenty of people who are happy to buy them in the 60s. We're in the 30s. I don't think 40 is very ambitious. I think that's a good target. So let's call that the spread. All right? So now I know what I'm going to construct. I want a 28-40 spread. I think I can get it for $4. So what I do is I right-click over here, and I get this thing, the little box. I say buy a vertical. And I'm going to buy. It already knows I want the 28s, obviously, but it assumes I want the 30s, which is silly. And what I do is just pull this down and adjust it to the 40s. Okay, and here you go. They give you the net on the spread for 410. See how that works? So they're telling me they think they can get it to me for 410. I can then change this offer to $4. In fact, let's do that and see what happens. I can change that offer to $4, and I got to right again. I'm going to check. I'm going to say 810 for that, and I'd have to get 410 for that. No, I don't think that's realistic. I think 410 is a fair price. So I'm going to go back to 410. I'm going to order 10. I'm going to say confirm it. And it's going to tell me that's going to cost me how much money? It's only going to use $1,300 of my buying. Well, that makes sense. It's going to use $1,100 of my buying power to buy 10 of them. Oh, well, no, actually, it's interesting because it's $4,000. But it only uses $1,100 of my buying power because it's on PM, this account. I hit send. So that's a good deal. I type $1,100 and I can make $12,000 back. So I'll be happy. We'll see what happens. All right, and if I really wanted it, I would just leave it. I would then leave it open on I hit that with on a day trade. If I did it good to cancel, it would keep it open, and then as it gyrates up and down, I would hopefully get a fill. All right, so that's the way to do it if you want to make a limit and get into something like that. I prefer, though, I would usually want to go and pick the direction it's going in, and then take the legs one at a time. Like I try to day trade the legs as a swing trade. Because if I really want to fill something, that's what I like to do. All right, so now I got to get going, guys. Sorry about that, but we don't have a lot of time today. Why do they buy back their stock? Well, why do you buy back your stock? You buy back your stock because you're out of ideas. You have money. You know, if I come and take over Chrissy Co. tomorrow, and Chrissy Co. has $100 million, and I'm the new CEO, right? And Chrissy Co. has, let's say you're a billion-dollar company, you have $100 billion in cash, right? Now, you're going to make the same, this year you're going to make $50 million. Okay, you're going to make 5% of your company's value. So your P of the company is 20, and you're going to make $50 million. So I'm the new CEO. My job, obviously, is to make more money, right? I'm coming in new, I'm coming fresh and make more money. I have $100 million sitting around. I'm going to make $50 million this year. And The company has a 20 PE ratio. So what am I going to do? Now, I've got choices. My choice number one is to hire people. I could hire people. I could buy machinery. I could acquire another company. What can I do with the cash? What can I do to generate more business, okay? The problem is most CEOs, because we have these CEOs that jump from company to company to company, that's exactly what Jim says. They're great they're operators. They're not allocators. Also, they don't know the goddamn business. That's another thing that drives me crazy. It's like, why do we kick out the owners of the company who built the company in favor of Wall Street guys and venture capital guys who come in to run the company? They don't know the company. There's no value placed on the actual business anymore. It's all about how much money this machine can make. Every business is really like a machine that has to make money and spit money out. But nobody worries about actually focusing on what the business does and how it works. And obviously not with Apple or Google or something like that, but I mean that's why they're so successful, because they have powerful owners who have a vision and keep the company on course. But smaller companies, they just get taken over and they get treated like they're just money machines. So we take over Chrissy Co., your life, imagine, selling all your life, and you get kicked out, you get kicked to the curb with your golden parachute, and now I come in there and say, well, I got to run Chrissy Co. better than Chrissy used to run it. All right, so I come in there, and I'm looking, and I'm like, well, I don't know what I can do. And the pressure's on me, because if I don't make some serious improvements to justify my ridiculous salary, everybody's going to say, what the hell did you kick Chrissy out for? So as the CEO of Chrissy Co., I say, oh, here's something I can do right away. I could buy back with half of the cash that we have. And cash, by the way, is not really valued by Wall Street. Having cash isn't something they consider a big deal. So I take half the cash we have, or even better, I borrow money. Borrowing money is even better, because I can borrow $100 million. Remember, you have $100 million cash in the bank. I'm going to borrow $100 million, which I only have to pay off over 10 years. So I have to pay back $10 million a year plus some bullshit amount of interest. I'm going to have $100 million. I'm going to use that $100 million to buy back 10% of Chrissy Co. from the public, right? So what happens? Next year, without me earning another penny, with the same exact business and the same profits and the same everything else, suddenly that $50 million is divided by 10% less shares, and I end up making 11% more money, 11% per share more money. That's why people buy back stock, because they haven't got a better clue or any other ideas, and they're not creative, and they don't know what to do with themselves, and it's a tight economy, and money is cheap. So those are all the reasons. And some of them are good reasons to buy back stock, but not at the highs. That's just stupid. But again, it goes back to, because the people running these companies do not have a better idea with what to do with money. All right. Thank you all for coming. I really appreciate it. I promise we'll get up that article, the post tonight with the proper links to BNN, and you can all watch the live show. All right. So thanks a lot. We'll do it again on Tuesday, normal time next week. All right. Take care, everybody.